Hello and welcome to where we bring history and finance together in ways that are simple, engaging, and insightful. Today we're talking about the fascinating story of Nedungadi Bank, South India's first private sector commercial bank, which rose to prominence but eventually met a tragic end. So, what led to its downfall? And how did it pave the way for modern banking interventions in India? Let's dive right in. Let's rewind to 1899. The year marks the birth of Nedungadi Bank in Calicut, now known as Kozhikode in Kerala. It was founded by Appu Nedungadi, a visionary entrepreneur who aimed to serve the local traders, small businesses, and households of the Malabar region. Nedungadi Bank was more than just a financial institution. It was a lifeline for the local economy, providing much needed credit to small businesses and fostering economic growth in Kerala. Over time, the bank expanded its reach beyond the state, slowly growing into a trusted name across India. For decades, it thrived, playing a pivotal role in South India's financial landscape. However, as the banking landscape evolved in the late 20th century, Nedungadi Bank began to face serious challenges. By the 1990s, cracks in its foundation became evident. One major issue was the rise in non-performing assets, or NPAs. Simply put, these are loans that borrowers stop repaying, and for a bank like Nedungadi, this was a ticking time bomb. Bad loans ate into the bank's profits and eroded its capital base, leaving it vulnerable. On top of that, poor management decisions and operational inefficiencies made the situation worse. The bank failed to adapt to a rapidly changing financial environment and struggled to meet the Reserve Bank of India's regulatory norms, such as maintaining a healthy capital adequacy ratio. Competition from larger, better resourced banks only added to the pressure. For a smaller bank like Nedungadi, staying afloat became an uphill battle. In 2003, the Reserve Bank of India had to step in to protect the interests of Nedungadi Bank's depositors. The RBI ordered a merger with Punjab National Bank, or PNB, one of India's largest public sector banks. At the time of the merger, Nedungadi Bank had 174 branches spread across India. Under PNB's wing, all its assets and liabilities were absorbed. This move ensured that depositors' money was safe and prevented a potentially larger financial crisis. This merger marked one of the first instances of the RBI using such regulatory intervention to stabilize the banking system, a practice that has since become a key tool in managing financial distress in India's banking sector. Today, Nedungadi Bank no longer exists as an independent entity, but its legacy endures. It remains an important chapter in Kerala's banking history as South India's first private sector commercial bank. While its downfall was unfortunate, it highlighted critical lessons about the importance of efficient management, robust risk assessment, and regulatory compliance in banking. It also set a precedent for how mergers can be used as a tool to protect depositors and maintain financial stability. So, what can we take away from the story of Nedungadi Bank? It is a reminder that even the most trusted institutions can falter without strong foundations. But it is also a testament to the importance of timely interventions to protect the greater good. If you enjoyed the story and want to learn more about the history of banking and finance, do not forget to like this video, subscribe to our channel, and hit the bell icon for notifications. Thank you so much for listening, and as always, stay curious and keep learning. I will see you in the next one.